Hello everyone. 2022 Union Budget was placed in against the backdrop where COVID still persists in the economy. Government needs to be pro-growth, but at the same time does not lose an eye on fiscal consolidation. Government has broadly stuck to all these requirements. Union Budget 2022 targets a 50 basis point consolidation. Central fiscal deficit is expected to moderate from 6.9% of GDP in FY22 to 6.4% in FY23. Starting FY21, the government budget has been focused on bringing transparency in its accounting. By this, we essentially mean that center has been retiring the debts of various quasi-sovereign entities and assuming a larger share of expenditure through gross budgetary support, thereby reducing the reliance on the resources of public sector enterprises. In fact, on the growth and receipt side, Center has budgeted a nominal growth of 11% for FY23 and a gross tax revenue growth of 9.6%. We find both of this to be tad pessimistic. In fact, we find the economic growth assumption of 11% and a gross tax revenue growth of 9.6% assumed for FY23 to be a tad conservative. We had a 13 to 14% nominal growth assumption in mind and a slightly elevated tax buoyancy. But given that the numbers are conservative, should there be any requirement during the course of the year to provide support for any COVID related relief measures, or should there be any requirement to reduce custom or excise duties if the crude prices and other commodity prices are elevated? This conservative estimates will provide some space over there, as we do expect that eventually, just like FY22, in FY23 as well, your total tax collection could surprise on the upside by good 1.5 to 2 trillion. Coming to the disinvestment, government has projected the disinvestment proceeds of 780 billion in FY22, followed by 650 billion in FY23. We are given to understand that the work is progressing fast on disinvesting the 5% stake in LIC, and hopefully this makes these assumptions look credible. Overall, the message that we want to give on fiscal math is that by being conservative on revenue and growth projection and assuming a greater share of budgetary support by reducing the reliance on the resources of PSEs, government lends credibility to the fiscal numbers, and the consolidation targets for FY23 looks achievable. Total expenditure in FY23 is budgeted to grow by 4.6%, but the construct of the spend has shifted increasingly towards capital expenditure. Capital expenditure via gross budgetary support is budgeted to grow by near 25% on top of 41% growth in FY22. But higher capex via budgetary support gets partially offset by lower capex through extra budgetary resources. But on a net basis, capital expenditure, particularly those towards infrastructure creation, will still likely grow by double digit in FY23. Even within the spends, which are accounted as revenue spend, allocation towards subsidies are falling, and higher spends are directed towards various centrally sponsored schemes, such as towards rural roads, irrigation, water, and sanitation. Overall, the quality of government spend is definitely getting skewed towards pro economy buckets. Within infrastructure, railways, renewable energy, water and sanitation, and defense are the key areas to see expenditure boost. Budget allocates a higher spend on rural infrastructure, where we see 21% growth, but shaves off the allocation towards MG Narega and food distribution. Hence, the cash flow to the rural India doesn't see a meaningful leg up in the bucket. Now, coming to the market, bond market had entered into the budget with two broad expectations. First, it expected gross market borrowing to be within the range of 12 to 12.5 trillion. Secondly, it expected some announcement from the budget which would expedite India's inclusion in various global bond indices. Market was disappointed on both the fronts. Gross market borrowing in FY23 is likely to be 14.3 trillion, which is significantly higher than 12 to 12.5 that market had in mind. Secondly, there was no mention on the roadmap for bond index inclusion. Though in the later media interaction, finance ministry officials did indicate that the work is progressing on that front, but that did not provide any major relief to the market. In fact, post budget, yields rose by 10 to 20 basis points across the curve. With global trade dynamics turning aggressive and RBI being absent from buying government bonds since October, November, in fact it has been selling bonds since November. The market is finding it increasingly difficult to absorb the supply. 10-year benchmark has risen by 60 basis points over last couple of months. Inflation outlook for India is not worrisome like many other economies, but it may be time for the central bank to unwind some of the extra accommodative settings on both rates and liquidity front. As such, hence we would still advise some caution on rate. Equity market, on the other hand, cheered the budget. The continued higher push towards public capex, in particular infrastructure, is probably the biggest takeaway for the market. The focus of this year budget was infrastructure spending and to boost domestic manufacturing through various measures. Besides all this, the government also emphasized on climate change and announced measures that will support renewable energy sector. Higher allocation to the PLI schemes could be interesting for domestic equipment manufacturers. As a caveat, though, the feed through of the fiscal math into bond yields could weigh on the equity valuations, which are already expensive, and hence it needs to be watched out. The current equity market dynamics are conducive for bottom up stock picking. That's it for this month. Signing off. Take care.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.